a choice. This is why there is pressure on remote, regional, branch services. This is why there's questions around the sustainability of cash, which absolutely will be available well beyond any of our natural lifetime. But the costs associated with that, the way that that's actually priced for and recovered, is quite a challenge. And I think maybe perhaps conscious of not using too much of our time, I think we think about that in the context of, as an institution, our history and our wish is to continue to be the bank for all Australians. We serve a breadth of customers across a range of different aspects of Australia that is unmatched. We see some aspects of that where, to make it real, approximately 50% of the customers that we serve in retail banking, we wouldn't recover the costs of that service. Now, of course, that's at our scale, so you can imagine what that might look like for other institutions, which is why you're seeing, again, pressure around cost reduction and changes. Now, obviously, you don't need every customer in any business model to be recovering all of the costs of that service, but when those cross subsidies become quite large, it's actually very difficult and, one may argue, unsustainable. So I flag those issues. As I said, we're very proud of our history. We recognise, believe we play an important role in the Australian economy. We are acutely aware of the obligations that are upon us. Perhaps some of those topics are of interest today. I suspect even if I'm here in 12 months' time or approximately this time next year, some of the things we may do, which you might be asking me about, I think I may be able to trace back to some of those comments. And with that, Chair, perhaps I'll hand over to you, and of course happy to answer the questions from the committee in whatever capacity we are able to.
Tremendous, thank you, and thanks for the breadth of that opening statement as well. And I know that there'll be interest from members in pursuing different elements of what you started with. In terms of what I'd like to start with is one of the reasons that this inquiry exists, which is the Royal Commission, the Banking Royal Commission. I wanted to inquire about how CBA is ensuring that the intent of the Royal Commission is not only implemented but constantly and continually reviewed, so that recommendations made nearly 7 years ago remain effective. So let me kick off with these two questions. First, the CBA last provided a formal update on your institution's implementation of the Royal Commission recommendations from memory, and if I'm wrong, please correct me, in October of 2019. So the two questions are, how frequently are you formally reviewing your implementation of the Royal Commission recommendations, and when will you provide another formal update publicly? And can I just emphasise too, if there are questions, again, that you want to take on notice, but at least use that sparingly, I'm more than happy for you to do it, but there's an expectation about timely response.
Sure.
Sorry.
No problem. I'll certainly seek to answer as many questions today as I can, or I'll try to restrict any that I take on notice. Look, I think maybe perhaps firstly, to answer the second part of the question, happy to provide a comprehensive update in writing at any point in time subsequent to this. I'd say we reasonably regularly review the Royal Commission recommendations implementation. I only say that because there is very little, if any, change to what we would have provided in that update. October 2019, maybe there was a few small items that are outstanding, maybe things like the compensation scheme of last resort. There's been changes, which I'm happy to talk to, around lender remuneration for our lenders. Of course, there were some recommendations that weren't implemented that are outside of our scope. But I think if you actually did the side-by-side, my sense is there'd be a very close matching between that update and very little change. Now, that's not to say that there aren't elements that we should be constantly and do monitor. You might recall in May of 2018 that APRA published a prudential inquiry. I revisit that document regularly, mainly because I think there are I think it's a very whilst it was damning, I think it's a very well written and very insightful document. I think there are some aspects within that are forever a challenge in a financial institution. I worry about what the impact may be for people that perhaps weren't seared by that experience. I think time certainly has the potential to erode the saliency of those sort of questions and issues. And of course, people change. There's many new people within the organisation. But also, Chair, one of the things that I would look at is, I've been in the Commonwealth Bank for 25 years. CEO for 7.5, and on the executive team for 13. I think the way, and I mean, I could list many examples, and I say this as a huge positive, obviously, the way that we manage customers, the variety and the breadth of different services and vulnerabilities that we support, the obligations not just on financial institutions about what's the contractual obligations, what's in a contract, how we must go beyond what's in that contract, and frankly enforcement, if it ever comes to that, is vastly different to banking of 10, 20, 30 years ago, and through many dimensions. I'd be happy to provide examples.
And if I could just add, in addition to Matt reading the report, I can also offer that he asked his senior leaders to do it, his direct team. I asked my direct team to do that as well. So it is actually a document that we use in a living way in the organisation to really kind of reflect and continually think about, and as Matt said, to make sure that learning stays alive.
Thank you. So one of the recommendations, 5.6 of the Royal Commission, required, quote, all financial services entities to assess as often as reasonably possible the entity's culture and governance, identify any problems, deal with them, and determine whether those changes have been effective. So following on from my last questions and just a couple of others, what have you done to determine whether the changes you've made to governance and culture have actually been effective? What metrics does your self-assessment framework involve? How frequently do you reassess that? And also, do committees of the board actively assess CBA's response management to the Royal Commission? And how often is it a feature of board and executive management business and discussions?
Thank you.
And if there are any questions you need me to repeat, please let me know.
I think I certainly have the broad elements, but perhaps if I miss anything, please let me know. It's very sort of topical and entirely, I think, coincidentally, we were going through many of these issues yesterday. And why do we do that? Well, at least annually, the board also takes and forms an assessment around risk culture. And perhaps without getting sort of like too technical, within banking and certainly within the executive level and with the board, we think about what is our culture. There are many, obviously, explanations, but for around culture, I personally like simplified ones which focus on things like how decisions are made, especially when they're difficult. What are the sort of processes, symbols, leadership, tone that would otherwise, influence and heavily shape that culture? There's a subset of that within risk culture. This is touched on in the Prudential Inquiry report. I think it's about page 82. There's about a dozen pages in there in culture. It's one of the best explanations I've read around culture and risk culture. We typically do surveys. We did a detailed survey a couple of months ago. We'll do a sort of sampling survey between now and February, and we'll do another full survey. Now, in that survey, we're looking at many questions and drivers, some of which relate specifically to engagement, employee engagement, because obviously it's a very high predictor of the sorts of engagement in the organisation and the outcomes we deliver for customers. Culture, which is a broader range of questions, and we've typically tended to focus on a set of questions that APRA provided in the Prudential Inquiry, and we've repeated, which is, I think, from memory, 8 or 9 specific questions, and we do sort of an aggregation of that in and around risk culture. We have at times seen fluctuations. There are always points of interest and focus for us. This is a topic of real importance to both the management team and the board, because obviously these things have to be interwoven, I think need to be carefully curated and considered over a period of time. And when examining each of those sort of questions, obviously people can answer those questions with multiple lenses on them. I know specifically as it relates to risk culture, because this is a topic of interest for me. There's approximately 4,900 verbatims in our last all-staff survey. And so it's quite interesting. There's some consistency, there's some real inconsistency, and it's sort of our job to make sure that there's an adequate focus on risk management. I'm happy to touch on a couple of the other topics that I think are really important inside an organisation, that information flows up and down very carefully. There's a very well-resourced and well-understood accountability and clarity over risk management, that anyone inside the organisation feels that they can appropriately, constructively challenge. That challenge is received well and encouraged by managers and leaders. These things sound easy. They're actually harder than they may sound, but they're very important, and therefore perhaps that's why it's relatively easy for me to speak in some detail about this topic.
So just on those 4 questions I've asked, and because there's a lot to canvass, can you also take those on notice and respond, if that's okay?
Yeah.
Moving on to financial hardship. So my next questions relate to service delivery, particularly in respect to customers who face financial hardship. And ASIC identified between 2019 and 2024, CBA charged $270 million in excess account keeping and overdraw fees for about 2.2 million low-income customers who shouldn't have been charged those fees. And it's by far the most of any bank. So your institution, unlike other major banks involved and against ASIC's stated position, didn't issue a bulk refund to that cohort of eligible customers, and instead you're making what I understand are, quote, goodwill adjustments where appropriate. So I do have a series of questions in respect of that. One is, why did the bank make that decision instead of just issuing a bulk refund? Why is it up to individual customers who are financially vulnerable at that? Why do they have to call the CBA to get a refund for fees that shouldn't have been charged in the first place? What would you say? I'll just do 3 questions first. What would you say to an average customer who might think that if the roles were reversed and they owed money to the bank, that the correction process would be far quicker and way less onerous?
Well, there's many dimensions to that. Perhaps I'll answer it the way I'd answer it, and then I'll try and translate it to how I might answer it to the customer as you expect, as you asked, Chair.
Yep.
So maybe let me just go back a step. I probably ASIC some reviews in terms of like hardship. That typically tends to where there's outstanding money owed on lending. So maybe we'll put that to one side. The origins of the review by ASIC were to look specifically at the Indigenous customers. We supported obviously all of that work. We refunded those fees for that cohort. I think the methodology and the amount that we paid is approximately $25 million. It's substantially more than any others. Perhaps our methodology was more comprehensive. There's no question, as to my opening comments as well, that we serve more Indigenous customers. Now, ASIC extended that review, and I'm not critical at all, of course, of the review. It's both their prerogative, and I can certainly understand why they would do so. They then extended to all concession holders. Now, I'm not suggesting there aren't concession holders that are of low income, but I also know that not all concession holders, because some you just qualify for by age, are therefore deemed to be, in my view, low income and socio-economic. This is a difficult issue. This is one of the few that I think we haven't been able to readily get to a quick resolution with ASIC, which gives us, of course, cause for concern and pause. Now, specifically to your question, there are multiple ways to think about it. And if I was you and I was talking to a number of consumer groups a week or two about that, about this topic, I'd be looking at me and thinking, well, you work for a financial institution. Your institution makes lots of money. Why don't you just give that money back? Now, I can certainly understand that, and it's perhaps related to some of the comments that I made. Now, we have to make a distinction between generally where a financial institution, well, entirely where a financial institution has done something wrong, they're remediating and making those repayments. In this particular instance, there is no instances of unlawful conduct. These are fees and charges that were associated with those products that operated in accordance with the terms and conditions. Now, there's a multitude of different fees. I wouldn't necessarily. We've made a number of changes going forward. There is very little practical difficulty in terms of changing the terms and conditions, changing which fees.
I'm loath to interrupt, Mr. Comyn, but sorry, I'm not suggesting, I'm not stating that it was unlawful, but ASIC came up with a figure of $270 million that they reckon wasn't charged in the right way. Is CBA disputing the $270 million?
It's slightly more than that. I think it was $285 million, but your number is very, very close, obviously, to that number. I would dispute whether it was. What was your exact characterisation? Charged.
That they weren't charged properly.
I disagree with that. They were charged in accordance with the terms and conditions. Now, there are multiple different fees within that. We can debate with whether each of those fees and whether customers who tended to incur those fees more frequently Whether
Let's not pass it. Look, there was 285
Yes.
mil that was excessive, and so there's amount that's owed back to those customers. Is that isn't that a fair characterisation?
Well, logically, I'd probably make a slightly different characterisation, and I'm certainly not trying to be argumentative. I think those fees were charged. They were charged as published and in accordance with those terms and conditions. There was nothing improper about those charges. Now, do I think that every one of those $285 million that were charged to customers, the way that they were incurred, even though they may be lawful, is there an alternative test over and above that? And that's ultimately, we would say yes, and that's why we're looking through what would be the appropriate level of compensation and to which customers. But generally speaking, when something is charged in accordance with the terms and conditions on a retroactive basis, it's not merely a question of just handing the money over. It's of course not my or our money. It's the money of our owners. And I think perhaps there's a sort of harsher interpretation of how a shareholder may think of that, which is, well, that's effectively appropriation of their property. Now, there's a balance between 0 and 285 million. We're trying to strike that 285 million. At some level, to be candid, I'm not necessarily moved as much by the different decisions that other institutions make. You can see within that report we serve more than I think it's either 2.2 or 2.4 million concession customers.
No, I understand that, but
we have to be able to serve them with some commercial model, and we've, as I said.
No, I understand, but can I just again, I'm just loath to interrupt, but just because time will be the enemy of us both. You're not. Can you just dissuade me that I'm not hearing this incorrectly? You're not challenging the figure that ASIC has identified as being excessive?
I'm not challenging the figure. I think we may debate whether every dollar in that is excessive. I would say there's a threshold within that, i.e., this is perhaps a poor comparison to draw. There are many other things, obviously, that we charge for. In banking, obviously, there's many things that incur a cost that we don't charge for. There are other things like net interest income. When we make a loan, we charge interest. Some may argue over what threshold rate that interest repayment is excessive. If I'm paying 5% on my mortgage, but I could show you the net interest margin, I could show you all of the costs, and we may differ. I could show you the return profile within mortgages, and I think perhaps we'd form different views about what's the definition of excessive.
Well, obviously, it's different from a corporation's perspective to the individual and average customer. Like, they'll feel it in different ways. Just going back to that question, though, the feedback that's coming out is that customers feel like they have to go through extraordinary hurdles to get that money back. How are you doing that? And just on notice, if you can take these questions, what's the process for a customer to obtain, quote, a goodwill adjustment? Does it involve automated responses? And also on notice, how many goodwill adjustments have been made and to what value? But coming back to my other point, why is it that it just seems like that there are hurdles in getting that money back?
Yes, so perhaps I could clarify that. So in the Indigenous customer cohort, as I spoke to, the $25 million was identified and fully reimbursed in an automated process. There is no requirement. Of course, it's possible, but I'm not aware of any instances, certainly with any level of materiality, where any customer was missed. There is nothing relying upon, and we're certainly not seeking to make adjustments on the basis of whether somebody asks for them. We're simply trying to identify that there's what that threshold will be. Clearly, there's some complexity and there's some judgment associated with that. Those considerations, I hope, but it would be premature for me to bring those to a conclusion here, but I'm certainly hoping that we can make a final decision and determination, which may or may not be entirely acceptable to ASIC, and we would then commence remediation, commence goodwill adjustments, not remediation, to those customers as quickly and as promptly as possible, which would take approximately 6 weeks.
Right. Even though lenders are legally obliged to lend on these questions, before I hand over to the Deputy Chair, sure. I have some on artificial intelligence and emerging tech, but I'll do that later in the hearing because time's against me. Even though lenders are legally obliged to consider hardship requests, AFCA has reported failures to respond to requests for financial hardship assistance, that those have risen over 4 consecutive years, and they've noted an industry-wide trend, so industry-wide, of what they describe as a cookie-cutter style, automated responses being delivered to customers requiring or requesting this type of assistance. So the 3 questions I have is, do you have an automated system for hardship request responses? How accessible is applying for hardship assistance at the bank, and what's being done to improve hardship application processes, especially if you're not responding to them now with people in the position to help out? How does it get better with, say, an AI-driven model?
Well, perhaps there may be some specific elements of that question that perhaps I'll come back to on notice. But to your question about, we've made significant investments in our hardship processes, investing in the underlying technology, and perhaps one of obviously the biggest challenges for us, for our customers, of course, was during COVID.
Yeah.
You know, approximately 13% of our home loan balances, I think from memory, went on to a deferral. To be able to support that at that volume, obviously in a very compressed time, we had to try and build as much automation into that.
Yep.
So there's definitely automation within the processes. I think they are robust. I'm certain that not every element of that would be automated. I think we're certainly always alert to any individual improvements. It's important, obviously, to hear individual instances. As I said, I met with a number of community groups a couple of weeks ago. There were a couple of specific examples that they raised, and in the process of investigating those. But in the context of hardship, both in substance, the sorts of options that are available to customers, as I said, the flexibility that's there is very, very different to what was provided many years ago. And I do think that overall the processes are quite robust.
And if I could just add to that.
Sorry, if I can, I've got to manage in terms of, we've got a lot of questions, and I'm a stickler in terms of time. If there's any additional information you'd like to provide, just provide it in response in questions on notice, if that's okay. Okay, over to the Deputy Chair.
Thank you, Chair, and thank you, Mr Common and Ms McLeod. The Chair is doing a great job keeping us to time, so I may, apologies if I cut you off or interrupt if I feel you've answered the question, just to get through them, so just apologies in advance. I'm going to shift to housing, a few questions on housing, and first up, specifically on the government's 5% deposit scheme. It's in the news today, property prices grew at the fastest rate in 2 years, with price increases most concentrated at the bottom and middle market, where first home buyers are most likely to be found. At CBA, have you seen an increase in demand since the 5% deposit price scheme began? And can you confirm from your data that higher demand usually leads to higher prices?
Higher demand leads to higher prices. I think substantively, the vast majority of the policies are focused around expanding supply. I mean, specifically to your question, I think in this broad level of support to homeowners we've provided, I think it's 38,000 since 2022, which I think is a relatively small number. I think it's obviously helped some customers, all of those customers go into the housing market. We have not done any of our own specific work looking at how much of the demand side would have shifted with a variety of both Commonwealth and state schemes over that time. So without having studied it, I know Treasury did some work. My suspicion would be that it's a very, very small element of the pickup, causally to demand. I mean, housing credit at the moment, this isn't, perhaps worth a brief comment. It's running at about 6%, slightly higher for investor. I'd say that that's, and obviously we benefit as an institution where housing credit is higher, but for long-term financial stability, for equality and access to the housing market, I think a slightly lower level of credit. If I could speculate, I think that's probably pushing a higher level than perhaps policymakers and regulators might be ultimately comfortable with. It will be interesting to see whether there's some moderation to the demand side of housing, given there is, I think with good reason, much less confidence that rates will be reducing in terms of interest rates anytime soon.
And when you just said it's pushing a higher level of, was it demand that policymakers may be comfortable with? What you're saying, the 5% deposit scheme?
Sorry,
or?
no, just credit growth. If you think
Growth.
if you think about housing, I think obviously we're all aware in terms of house prices and credit growth over a long period of time. I'd say certainly our view would be that a more sustainable credit growth rate in housing would be slightly below the current level, and I just think that it's important. In times that have gone by. Probably most significantly in approximately 2014, and then obviously during COVID we see big increases in terms of demand. There are many forces that shape appetite for housing, including obviously some of the incentives that are available. So I just think it's important as a financial institution and the largest home lender. We've got more than $600 billion of home loans. We're just very thoughtful about demand. We're very supportive of the work that's been done at a federal and state level on supply. We recognise the difficulty of that problem. I'll be happy to talk to any of the supply side things that we've been focused on.
Great. And I might come back to the supply side, and I'll also come back to credit growth growing faster than you think might be in the long-term interest of the economy. But I'll come back to that. But to stick with the 5%, I think the AFR said the bottom end of the market has been growing more quickly for the past 2 years as home values have been rising up to 10 times faster than wage growth. And I note the Barefoot Investor has been saying the government's 5% deposit scheme will trap, quote, young buyers into becoming postcode povos, saying with maximum debt and minimum buffer, you're one bad year away from disaster. Do you agree with Scott Pape that the 5% deposit scheme can increase risk for the most vulnerable in Australia's society?
I haven't read the article. I'd like to, and I'm not sort of seeking to evade the question. Maybe there's a few elements to that. I do think, and I obviously see this up close, it is very challenging for younger Australians to get access to the housing market. Now, clearly, boosting supply and a high proportion of volume of affordable housing is the most critical aspect of that. The question is always what, if any, and support should be provided to first home buyers, how to do that in the most targeted way. Now, housing has proved to be, which is of course no determinant in terms of future performance, a very good asset class for wealth creation over a long period of time. The simple reason why that has worked for generations of Australians is even though they may have been highly leveraged, taking on a lot of debt, their incomes have been able to grow.
Just on the 5% deposit scheme, yeah. I get that. I get supply is important. I get housing's been an asset that's inflated. But my question specifically on the 5% deposit scheme and how that's affecting low-income people. And if it is, house prices in that are going up for the bottom. The past 2 years, they've been rising 10 times faster than wage growth. And the Barefoot Investor talking about, he specifically says, not only does he talk about postcode povos or your 1 year, he does some analysis, which he says, look, if you take the median dwelling, about 850,000, on a 5% deposit, that would translate into about $841,930 of interest on a 30-year loan. Compared to a 20% deposit, that works out to a difference of $132,936 extra. So I'll ask the question again, but again with another fact. Do we agree that the most vulnerable are paying potentially hundreds of thousands of dollars more interest, given they've got this smaller deposit now than what they otherwise would have? And do we think this is increasing risk for those most vulnerable?
You have to look at the underlying assumptions from the numbers. Like I haven't read his. Let me just.
Would a smaller deposit
if you have
more
a higher principal, and it takes longer to repay that principal, you will pay more interest. That is unquestionably correct. I'm not 100% sure though in those calculations because with a 5% deposit, and ordinarily if you have less than 20% deposit, you'll be taking out lender's mortgage insurance. That could be thousands of dollars. It may not be enough, but it's true regardless of whether there's a government support. Obviously, the more you borrow and the slower you pay that back. And so if you're, at any point paying interest only versus principal and interest. And I mean, 85% of our customers are ahead on their repayment. So there's no question the amortising curve will support. You will pay more interest if you're paying, if you are borrowing at the absolute maximum, and your serviceable income, your household income that's available to repay that loan is at the maximum to just meet the interest repayments. There's no question that.
And do you see more risk from those people accessing that scheme? Are they potentially taking on more risk compared to people who aren't taking on that scheme?
Well, on the basis of the, as I said, the aspects that I just mentioned, the reality is the answer would be yes to that particular point. The loss rates in mortgages, and of course, we have to look at it at a portfolio basis, mainly because unemployment has been so low. So if there's a change in unemployment, that will make big differences. Yep. But I mean, the reality is when you look at loss experience over multiple decades, it's heavily causal to change in employment circumstances. Then secondarily, it tends to be related to a personal illness, which perhaps when I said the first one, change in employment circumstances. And then thirdly, sometimes would be relationship breakdowns, which can cause financial difficulty. So it's hard to generalise, but also specifically I can see that the point that you're making, I wouldn't refute that on an absolute sense. Perhaps the magnitude, before I'd be willing to comment more specifically, I'd just like to see the calculations.
Yep. One other data point we could point to, though, is the 90-day arrears for those in the scheme is actually lower than the overall portfolio.
Okay. I might move to another question, if that's okay. And I'll move to something you were touching on a little bit, but the banking book split between, or the retail banking book, the banking books loan split between consumer, largely mortgages, and businesses. From looking at APRA data, the loan books of Australian banks seem to have shifted over the last 40 years from roughly 1/3 consumer, which are almost all mortgages, to 2/3 business. From 1/3 consumer and 2/3 business to 1/3 business and 2/3 consumer, largely mortgages. Is this reflected roughly in CBA's loan book? And if so, what's driven this transformation?
So this is an interesting question. I'm happy to furnish any of this information. Maybe what I'd say, if you don't mind me, I'll just give you a very quick historical arc. Non-retail, so non-housing borrowing in the banking system peaked, I think unsurprisingly to many here, in the late 80s and early 90s. We had a significant financial both recession as well as heavy losses of commercial real estate, which still remains to be probably the epicentre of many bank failures over the last 100 years. It was at that time sort of 2/3 non-retail, 1/3 housing. I think by 2004 it had reduced to about 1/3 non-retail and perhaps more the remainder, so 2/3 sort of housing. If you look at nominal terms, they've grown sort of slightly faster in housing, but actually if you take out offset, and maybe there's too many assumptions here, but offset is something that basically reduces your loan balance. Actually, business lending has been tracking slightly higher. I think perhaps what's more significant, and this has been our focus, is over the last 4 years, business lending has been growing at twice the rate at an industry level versus housing, and I think that's a very positive thing. For us, the numbers are even more stark. We lent $57 billion. All the growth rate would be 55% over those 4 years versus 22% in terms of housing.
But just on that specific question, over the last 40 years, is it true 1/3 consumer, mainly mortgages, 2/3 businesses? Now it's 2/3 housing, consumer, 1/3 business. Is that largely true or not? Am I wrong?
We've got to make the distinction between flow and stock. So if new loans, no, faster growth rate in business. But in terms of obviously the stock of loans, much larger. So $610 billion of housing. We'd have 220 billion of business lending.
So it's about 75-25. So it's a bit worse than the third.
This is a stock.
No, just
big
wanted
numbers.
to get
It's the flow that really matters.
Yeah, but that stock has changed. The flow feeds the stock. And so that flow and stock has changed over that 40 years, roughly.
Yes, and that stock would have reduced. So the imbalance, and like I said, there is significant difference between, a 55% growth rate, if that continues, versus a 22% growth rate over that time.
And have you done any research on, since we have then moved from something where it's largely businesses using credit in the banking system to loans, any research on the impacts this might have on the broader economy? And the way I try and understand it, maybe you can tell me if this is flawed, aren't we lending just basically so people can trade houses for one another for the most part, versus actually investing in businesses which are actually investing in the productive capacity of the economy? Or am I missing something there?
No, I mean, I certainly agree with the second part. I mean, it's not to say that, of course, housing is a very important both social right. It's an important investment, so I don't want to diminish the importance of housing. But I mean, in the essence of your question, strategically, and why is our lending growth rate? Because the risk profile is higher. Why are we allocating more capital there? It's fundamentally exactly the way you outlined it, that around productive capacity. Now, we try to do that on a diversified basis, even within business lending. Perhaps, not all of those loans are as productive as possible because there's a lot of commercial property in business lending. But I do think it's extremely important. We've been very focused on it. The regulated, it's often thought that the mortgage risk weights support higher mortgage growth rate. We actually run a mortgage risk weight that's more than double global standards. There's other factors that drive why people borrow in housing. They actually made some changes, as in APRA, which is probably in opposition to some of the Basel committee because of the sort of risk profile with business lending. At least our evidence would support both strategically and with the support of the regulator, which I wouldn't like to speak for them, but at times, may feel more uncomfortable. We are taking more risk in a number of areas. I'm happy to talk to how we've thought about lending policies. We do that eyes wide open. We think that's well within risk appetite. I mean, as I said, our loan losses are running about 8 or 9 basis points per annum. That's well below what we would expect to be the long run average. But as I said, when you're running at an unemployment rate of 4.3%, perhaps the long term average is something more like 6%. You need small changes in some of the macro factors to really change the loss rates. And I think this is why I think it is of interest and importance that there is a reasonable level of profitability, because when you have many, as we do today, banks earning below the cost of capital in the most benign credit cycle any of us have ever seen in our lifetimes, I'm not sure that sort of augurs well for the sorts of macro and geopolitical tail risks we're going to see.
Sounds good. Just on that, great you agree with that, and thank you for being so honest and open on that. Have you had thoughts, if policymakers wanted to see that rebalance a little bit and see businesses investing more productively in themselves to improve productivity, which we're all aware of the productivity challenge? Have you had policy thoughts on that, or has it come up in discussions what policymakers could do to better balance that? And if so, what are they?
I mean, it comes up regularly. We have a very constructive engagement with APRA, obviously, as the prudential regulator and as the largest financial institution with the opportunity to contribute to a variety of different, and I meet with them personally regularly. We talk about a number of these topics.
Is there any specific ideas that you think?
Well, as I said, they made some changes to the risk weight framework in 2023.
Yep.
Sometimes it's often talked about and evidentially supported that lending criteria, certainly in commercial real estate, was tightened significantly since the early 90s. Which basically took one major bank to insolvency. We have reduced, certainly eased some of our lending criteria in some of those areas. So things like pre-sale requirements, loan to value, different sort of covenant ratios. These are risks that a financial institution needs to manage. It's our obligation both at a management and a board level. But of course the prudential regulator is and should be interested in that. We regularly discuss whether we've got our risk appetite settings correct, what are the risks are that we're worried about. We've talked a lot about unsecured. So, I mean, to give you an example, during COVID, we originated more than half of the SME loan guarantee. We've turned that now into a $10 billion unsecured loan book. The process around that to get funding and financing is sub 15 minutes. We've expanded things like working capital
I might just ask one last question just before time runs out. And then we talked just slightly back on housing. And we talked about supply side and demand side. And you mentioned targets. You said you're happy to talk about them. I guess my question is how those two things interact. What you're seeing, do you have any thoughts on housing targets given what you're seeing on demand signals in your business, and specifically, population growth and immigration levels, particularly giving lending volumes you're seeing to new houses, and particularly given you're seeing building costs? So are those targets looking achievable to you, given what you're seeing on the data on your side and what you're seeing for immigration levels?
Well, I think demand and supply have clearly been in imbalance for some time. That's causing enormous difficulties. I think targets are important. It's a personal view. I think where there is a predictable level of migration, perhaps that number is something in the order of 180,000 per annum, gives both the Commonwealth and states the ability to plan for critical infrastructure, including housing. I think having a target is important. The difficulty, if I could say, at the Commonwealth is to have the target, you don't necessarily have all the levers, so you need a lot of coordination between the federal and the state level. I'm familiar with many of the state's policies. I can see firsthand, living in New South Wales, I know the Minns government are very focused on some of these supply side issues. They are not always easy to deal with. Areas like rezoning, supply, yes, construction costs, some of the input prices. I think the sort of availability of labour, of skilled labour in and around multiple sectors, including this one, is challenged. So I'd say, look, I think the target is stretching, but I think having a stretching and ambitious target is a good thing. Perhaps it may at times be politically unwise, but certainly inside an organisation, targets, even if they're aspirational, if they're well designed, are appropriate.
Thank you. Look, I agree with targets. Just want to make sure we're being honest if they're achievable or not.
Okay, thanks, Deputy Chair. I'll hand over to the member for Wentworth.
Thank you very much. I wanted actually to follow up on some of the line of questioning in relation to business investment. You touched on some of the things that you're doing to drive greater lending within the business within the business sector. I guess, and are there different policies that you have seen work in the past that you feel would support greater bank lending to business? You mentioned briefly the small medium enterprise guarantee during COVID. Do you have any comments in that space?
Policies are a broad remit. I mean, one of the reasons why the SME loan guarantee worked very well was obviously there's enormous uncertainty during COVID, and therefore it makes it very difficult as an institution. And there was a lot of trepidation internally about participating at the level that we did because, frankly, we had no idea what the loss rates were going to be staring into March. Now, that's where, obviously, we basically shared the losses with the Commonwealth. That's very helpful. I mean, any bank is going to want support to lower their risk profile. So, but let's put that to one side, because I'm suggesting that where I see it is appropriate. Where I see that work well, is probably more in terms of in emerging sectors, where there is a number of different vehicles that are available to support, and some of the sort of community housing side, where that's done to sort of crowd capital in, that's really helpful. I think it's less in many of these ways. I don't want to sort of abdicate responsibility to some policy setting. I think at times, I can give you an example. I was in Melbourne recently, and I was meeting with one of our clients. It's a very large home builder to both affordable housing, build to rent to buy. Why did that work for us? Well, actually, this is actually an example where industry super, and there's a couple of industry super funds, who I won't name only because I haven't sought their permission. They're the sponsor. That enables us to take a different view on the risks associated with it. It drives something known as the probability of default, enables us to provide that at a more at a lower interest rate, make some of those projects viable. To us, that's a very, very good thing. In areas like modular housing, we see enormous potential. I think Australia is really underdeveloped in that sector. Again, we've pushed ourselves. We've made some changes on both the retail lending side to make it easier for customers to borrow into a modular house because we typically like the value of the land. That's enabled a greater demand side for the modular housing companies. I think we're about 35%, perhaps more, of that particular sector. It's, I think, through concerted effort, sometimes at an individual institution, sometimes across parts of the institutions. I'd say, over many years, we've got good support from government at all levels. Modular housing is clearly an area of priority. Most of the time we're just trying to assess about whether, particularly where we're growing rapidly, and for us, if we're growing lending at more than 10%, as we have been in business lending now for several years, that's good. We certainly believe we're doing our job in terms of lending to productive capacity. We're, of course, always just thinking about, well, what's the stress scenario? You always have to think about, well, hope for the best, but plan for all the things that may go wrong. And that's why I think it's a very good and fair challenge. If I look at our loss rates, I'd be thinking, are you lending enough? You've got to put that against, as I said, the change in economic circumstances. And I think socially and from a community perspective, I'm not sure there is the appetite for some of the risk profile. It's very, very challenging when customers are unable to pay their loans and banks are enforcing on their security. I think it would be a set of circumstances that would be intolerable to community expectations that we saw in sort of past cycles in Australia. And I hope, like all of us do, that the economy and unemployment remains low.
I guess to a different question, certainly the one that is raised by business is to say we need to sort of regulate for growth as well as for risk. And I wanted to ask your perspective on, there's been sort of a lot of discussion from the government on the need to do that. How's that working, and particularly in relation to the regulatory grid which has been brought in for the banking sector? Is that helping in that sense of balancing risk and growth?
I think the grid helps realistically in modest ways. I don't know in some of these, and we've made a number of submissions in response to regulators asking about perhaps where there's some areas for improvement. I think it is a case of there's perhaps many small things that are incrementally small but perhaps cumulatively large, and you'll recall that we were part of that conversation at the Economic Roundtable around that, and I certainly won't repeat all of the discussions. I think there's definitely clarity about, and this isn't unique to Australia. I think there's very clear evidence from many countries around the world that they are very focused on a higher growth rate, productivity, and also supporting domestic capabilities and institutions. I think, obviously the Treasurer has written out to institutions. They've responded to those, their public documents. We've made submissions. Look, I'd say there is more to do. And look, I do think some of the perhaps issues that have been raised by regulators are very valid insofar as, some of these things are very easily said, not as easy to actually demonstrate. It's a little bit like simplifying the Corporations Act. It's a very complex document. It's not easy to rewrite and simplify the Corporations Act. Secondly, I think you have to think about what's the risk appetite? What are the settings that influence a regulator? I'm not sure there's a lot of evidence that regulators are encouraged with their risk appetite. And so I think it's actually quite a challenging situation. And I say that not just only as a financial institution. Regulation spans obviously all parts of the economy, and we have a very sound regulatory architecture, rule of law. We actually perform very well on a global basis in those particular dimensions. So I'm not suggesting for a moment that that's not helpful and appropriate. Like anything, if you can find targeted ways to reduce some of that regulation red tape cost with a scalpel, then that's helpful. And perhaps I'll just give one example, at least through our own lens. For non-retail or business lending, we're required to, above a certain loan size, do something known as an annual review. We've been able to, with the support of the regulator, automate the vast majority of that process. So we can, because we have the transaction relationship with our customers, we can see and form a very clear picture of their financial position. We think that's saving our business customers somewhere in the order of $50 to $100 million from an administrative perspective. Obviously, there are savings for us. So my suspicion, will be that it'll be more of those targeted things. It's often the cumulative effect of the regulation, the tone, perhaps the things that sit outside the actual documents and guides. You know, I hear frequently, and again, I say with some merit, you know, post the Royal Commission, those changes are entirely important. You know, are financial institutions more risk averse? Absolutely. I think it's a question about how to find the appropriate balance, and that's why, you know, whether it's culture, risk settings, these things need to be regularly challenged.
And then lastly, I wanted to move on to scams. We've discussed this before in this committee, and I think one of the challenges or questions has been about the sort of incentive structures for different banks and others on scams. One area I wanted to flag was the know your customer, sorry, not know your customer, but, you know, when the flags your customer when you're making a transfer. Sorry.
Confirmation of pay.
Yeah, confirmation of pay. The Netherlands has had this since 2017 and the UK since 2020. So my question really is, what are these incentives strong enough for banks to make the innovation and investment around this sort of, you know, these sorts of changes that can help scam reduction in the community?
Oh, I definitely think so. And maybe why would I say that? Because, as I said, in the category of economic crime, we're spending $1 billion cash this financial year. Now, that includes financial crime, cyber, scams and fraud. You know, scams is a very difficult area and issue, and obviously I can talk a lot to the work that we've done, which we've, you know, from at least the peak of scam losses, it's down 76%. There's a couple of particular scam types that are, you know, causing us some near-term concern. I mean, we're very supportive of the policies around the new scam protection framework. It may sound ironic, but they impose higher levels of obligations on us as an institution and of the industry. I think most importantly, and we should remember, the banks are never the scammers, that this imposes obligations on others in the ecosystem, telcos, tech companies. Working through points and areas of liability is really important. We wouldn't, notwithstanding, as I said, there are really significant near-term and long-term commercial and strategic pressures. We don't tie that into areas of funding like economic crime. But also, I think, Ms Pender, if the question is there more that the industry could or should be doing, I think it's very hard to ever answer it and say there isn't more that we could be doing. We're constantly pushing ourselves to think about what new technology we can bring in, what more can we be doing, and of course, like, how are we balancing. So some of the ways to really reduce scams is to create a lot of friction. And we've done that, obviously, by really limiting the amount of money that people can transfer into crypto, as an example. We've brought friction into some types of higher risk payments. Maybe an easy way just to explain it to me, every 24 hours, you know, our customers ask us, well, require us, based on our terms and conditions, to process 21 million payments. And across those 21 million payments, or individual payments, we've basically tried to assess each and every one of those and predict whether they may be the subject of a scam, fraudulent, whether they look suspicious, which come with a number of other reporting obligations. So these are incredibly important, and it's still, you know, more than $100 million that our customers would lose in a 12-month period, and that's, you know, that's obviously just a scourge, and also very, very challenging individually. I'm happy to talk about liability. I'm happy to talk about how we're thinking about it retrospectively, what our observations and lessons are. I certainly feel like the incentives are large. I can't speak for everyone.
Okay, thank you. And before I move on to the member for Bennelong, I think the moves in reshaping the mortgage products for modular are really important, and I think CBA's kicked off on that, so well done. Member for Bennelong.
Thank you, Chair. Thanks, Mr Comyn, Ms McLeod, for coming. No cash or card today, Mr Comyn, it's okay, but I do have this nice little...
I'm disappointed to hear that, Mr
This nice little diagram here, which shows, this is courtesy of MasterCard, which shows the breakup of the 8 cents on that $5.08 coffee. Interchange fees and scheme fees at the top there. I wanted to ask a few questions about scheme fees.
Might be testing my eyesight.
No, so I'm happy to show it around, but I'm sure you know it inside out. Ask a few questions about scheme fees, if that's okay. In your submission to the RBA's merchant card payment cost and surcharging consultation paper, you modelled their draft plan, and you've got a quote in there that says, your model shows profitability for schemes and digital wallet providers are likely to further expand based on the RBA's draft plan, and that these fees operate without the scrutiny that interchange faces. Just touching on some of your comments in your opening statement, are you concerned that international schemes' profitability will grow at the expense of Australian payment innovators and providers?
Yes, I am. Would you like me to expand a little on
I would
each of
like you to
those?
expand on that, please. Yeah.
Well, because, and I think it's a matter of fact that interchange has been regulated. It is perhaps from the RBA's perspective much harder to regulate scheme fees. I think that's been a source of litigation in the past. I don't necessarily think that should be a deterrent from a regulatory perspective. I think over that period of time, from memory, whilst interchange has been continuing to come down, scheme fees have increased. Now, scheme fees, I'm talking about MasterCard and Visa, international global schemes, increased by about 8%. It's probably, certainly more than $100 million. We have a domestic scheme, not as familiar with those numbers, but if you look at the pressure on compression, the compression on interchange versus scheme fees, it tells a very clear story, and to the extent that it's not evident in that submission, happy to provide information. One of the principal issues that we have, as I touched on earlier, is not just the movement or the reduction in the interchange levels, it's also how they will apply to domestic institutions and not what are known as three-party schemes. So a four-party scheme is an individual acquirer. Think about a payment acceptance, an issuer, someone who's paying with a debit or credit card, and the international schemes. A three-party is American Express. They're both the acquirer and the issuer. They're exempt from those regulations. They're actually under the PSRA, the RBA now for the first time, and to be fair, they've been asking for many, many years to get those powers. We've been very supportive, and they now have them. I think our question to them as part of the consultation process would be, why not design the totality of the changes in payment acceptance or the cost saving we're looking to deliver at a national level? Why not design that deliberately with all of those powers that most appropriately balances a number of factors across schemes and international acquirers? Because I think, to state the obvious, there'd be a very low level of investment in American Express as a US domiciled company. And then Apple Pay, well, you may guess I'd be delighted to answer your questions, but I may need to take some sort of legal advice about how the multitude of NDAs that we're under restrict me and how that would intersect with parliamentary privilege. But perhaps that may be an area, if you were to put those questions on notice and require an answer, it may be easier for me to respond to them.
Yeah, I might do that because, as you've suggested, they're international schemes. And my definition of scheme is your Visa, MasterCard, but you're right, those digital wallets too. It may not fit the industry definition, but they're all players in this cost, right? And so these are typically multinationals that pay little to no tax here in Australia. I mean, looking at the 23-24 Transparency Index, MasterCard paid no tax on $357 million worth of income, Visa $3 million worth of tax on $108 million income, Google $130 million tax on $2 billion worth of income. So if these schemes, by your modelling, increase their profitability, some of them pay no tax. What long-term impact do you think this will have on the domestic payments industry and, by extension, on small businesses and consumers?
Yeah, I think it's an excellent question, not just because I align with a lot of the sentiment. I mean, I think it's going to have a negative impact on the industry. On small business, I'd like to come back to small businesses because I think they're a very important stakeholder in this process in and of itself. I think this is a really important question, and it's certainly not just limited to payments. We see this in many industries, like the media industry, the telco industry. There are other players. Netflix, as an example, I'm a subscriber. I can't remember what their total revenue is, but it's more than $10 billion. I don't think they pay $1 of tax. I think as a point of principle in terms of like the sovereignty of Australia having a very clear view, and at least in my view, legal and regulatory playing field that is level, so that everyone that participates and operates here does so by the same laws and rules and makes, if not equal, and certainly a proportionate and fair contribution. One of the ways that should be done is through taxation. I understand the sensitivities that may cause in other areas, but I do think this is an issue that's only going to get worse, and at least in my view, that if not now, then when.
What scrutiny would you like to see on schemes and digital wallet providers?
Well, I'd put schemes in a slightly different category to digital wallet providers, but I will maybe conceal my sentiment about some of the digital wallets. Look, I think there's a degree. I think transparency is good. Clearly, transparency does lower prices over time. I think the totality of, Australia is a very low cost of payments acceptance market. By global standards, that's unquestionably true. But I also do understand that for small business, which is the vast majority of the surcharging is occurring in small business, and often in areas like hospitality or cafes. Obviously, running a small business is very challenging. I think we do need to come up with a solution that is even more cost-effective for small businesses. And as you know well, Mr. Laxale is an expert in this area now. Very large companies pay much smaller. There's a real skewing of the sort of payment acceptance costs. I think these are all important issues, but it's harder for the RBA, I suspect, to perhaps regulate them in the same way. I'll leave it to them to discuss that, but I certainly do think from a policy perspective, and obviously from the Commonwealth Bank's perspective, incorporating all of the players in the ecosystem and adequately considering those so that we're delivering optimal outcomes ultimately for Australian consumers and businesses.
I'm no expert, mate. I'm just winging it half the time. Last question.
Very last.
You come here, front up, do this inquiry. Do you think that Visa, MasterCard, Apple and Google should as well?
Sure.
Thanks.
Okay, thank you for that. We'll now cross to the member for Bowman, coming to us live from Brisbane. Over to you for your 10 minutes of questions, Henry.
Thank you very much, Chair. You mentioned interest rates earlier, and I just wanted to dig into that a bit. Given the persistent domestic inflation pressures and the strong population growth, is there anything in the data that leads you to believe that the RBA will be in a position to cut rates next year? Basically, based on your economic forecast, do you expect that the cash rate is going to be lower at any point in the course of 2026 than it is today?
Well, our economics team's forecast at the moment is that the cash rate will remain on hold for the foreseeable future. What does that practically mean? More likely than not through 2026. Now, of course, forecasting is a difficult game, and so I'm relying on all of the work that they've modelled. But perhaps, and I know the RBA has spoken about this quite a bit. I think clearly the more recent CPI data was higher than we were, and the RBA would have been expecting. The labour market remains strong. There was a slightly weaker jobs data, then slightly stronger. I think it's certainly unlikely that rates will move in the near term, and then we've just got to work through some of those issues to, ultimately determine. I think first and foremost, getting inflation back into the target band and what sort of capacity there is in the economy. Of course, lifting productivity is an important element of that. But to answer your question directly, no, I don't think a reduction in the cash rate is likely in 2026.
And what do you think are the main components to domestic inflation at the moment? In your view, what's proving most difficult to bring inflation back down to the target?
Well, obviously, if you'd asked me with the quarterly print before that, it was looking. It was obviously a very positive trajectory into into the target band. I mean, there was a spike well above sort of what we or the RBA would have been modelling. I think they were modelling 0.6% trim mean, and it came in at about 1. Question always with these, and there's a lot of volatility in the monthly data. The quarterly data does tend to have a lot of signal in it. And then the question is, are those price pressures that we're seeing? So, I mean, one of those sectors which we've touched on already was in dwelling, housing costs, construction. We've seen a pick-up and acceleration there. The real question is that a temporary price pressure? Is some of that going to alleviate into 2026 and moderate? Or are there other, is demand stronger than we otherwise anticipated? There's not enough sort of spare capacity in the economy. I certainly, from my perspective, and then there are, of course, much greater experts than I am. It's a little too early to tell, but I think there'd be a preference to make sure that inflation was back well and sustainably within the target band before there'd be an adjustment to the cash rate. All things being equal, of course, things like the labour market, obviously international factors could also shape that and already do play, a significant impact on the domestic economy.
What about energy costs? Would you say that energy costs are now a structural driver of inflation?
I think energy costs, of course, increase or have been an increase on pricing for many years for many households and for businesses. I certainly don't think Australia is going to be immune to that, and understandably, I think there will be ongoing scrutiny around energy prices.
Okay. I want to get your views on productivity. Has obviously been a key theme in the building you're in over the last few months. The RBA has obviously lowered its productivity growth assumption to 0.7% per annum. Treasury is using an assumption of 1.2. What's your bank's house view on Australia's productivity trajectory, and how's that shaping your lending, risk settings and outlook for the wider economy?
I couldn't tell, but I'm happy to take it on notice about specifically what our forecasts might be, but obviously I'd be very confident in the basis of which I would say that Australia, like many countries, has had sagging productivity growth now for some period of time. I think it is, of course, a very important determinant in terms of increases in real income and living standards. At times, it is a difficult problem. It requires a lot of focus. I think we've touched on a number of those areas. I think whatever productivity growth we can obviously create and generate within Australia is going to be a positive element. Clearly, some of the technology shifts that maybe I touched on very briefly earlier, and perhaps we can come back to, they will hopefully bring some productivity support. But there are, of course, with any technologies, I'm both optimistic about the opportunities, but also thoughtful about some of the broader risks. So, I do think it's going to take a concerted effort to increase productivity. I think it's going to need a lot of support, hopefully bipartisan support for a number of those policies, and to the extent if we can play a positive and a constructive role in either contributing to that debate and certainly supporting sensible policies that will deliver that, then that we would very much like to do so on an ongoing basis. As to your lending criteria, look, I think strategically, as I touched on earlier, we're focused on trying to boost lending to productive parts of the economy, obviously within our risk appetite. We, perhaps more than any other company in Australia, are leveraged to the underlying performance of the Australian economy. So, quite simply, if Australia's economic growth were to pick up, supported by high productivity growth, that's a very clear positive for the Commonwealth Bank.
Absolutely. I'm intrigued just to dig a little bit deeper on that one. What are you seeing across your books? Are your clients, are you observing a slowdown in investment in those sort of productivity enhancing assets or initiatives? What barriers are you seeing that are preventing businesses from investing in productivity improvements?
I mean, look, it's clearly mixed across a number of sectors, but broadly, I mean, business lending growth, as I touched on earlier, and we're still running at double digits and have been for at least the last 4 years. So, I mean, that certainly would indicate that, investment or certainly appetite to to borrow from a business perspective has remained high. I mean, some proportion of that is, Australia certainly by comparable standards have had sort of lower levels of leverage in the corporate and business sector. Look, I think economic performance, I think our economic growth forecasts are, I think, somewhere between 1.6 and sort of 2%. Different parts of the country and the economy, I think trading conditions are okay. I think many businesses did extremely well during COVID. There's obviously a lot of stimulus. I mean, but in differing sectors, you certainly still hear, but nowhere near to the extent that we did. There are sort of capacity constraints, particularly as it relates to labour. Some input costs. I mean, I think some of the broader themes, of course, there's, if you speak to a business owner, small or large, support for, less red tape, regulation, administration, of course. And the question is, how do you do that in a targeted way? And I think that does vary across different sectors.
But would it be fair to say that higher operating costs across the board, whether it be wages, insurance, rent, energy, are crowding out that capacity for Australian business to invest in productivity enhancing initiatives?
Look, I think many businesses would be experiencing, higher wage costs. They will skew depending on what the sectors are, and of course, factors like demand and supply. But having higher wages growth is obviously a positive aspect to that within reason. Depending on, if you're an industry that's very dependent on energy prices, then yes, that will have increased as an input cost. But I mean, some of those price pressures in energy have been underway for a extended period of time. I mean, but to your point, absolutely. At the end of the day, any business, small, large, listed, unlisted, is going to seek to earn a reasonable rate of return based on the capital or the equity that they've contributed. And so if their costs are rising faster and their revenue isn't rising at that rate, then of course they may have a less optimistic outcome. They may be less willing to make future investments.
Thanks, Mr. Pike.
One more.
It needs to be really quick because you've hit your 10 minutes. And if it needs to be taken on notice, then we'll take it on notice, but go quickly.
Yes, I just wanted to ask about the Net Zero Banking Alliance, which ceased operation last month and that Commonwealth Bank was a member of. Now that the alliance is shut down, will you be revising your lending policies in relation to commitments around ESG? And I'm just interested in some background around what impact that had on your lending practices.
Mr. Common, brevity is your friend here, if it's okay. And if you want to take things on notice, please do.
I'll try and give a very brief answer. I don't think it's going to have much of an impact on our lending policies. As you said, it's sort of been disbanded. It's somewhat of a moot point. We're always trying to determine what we think our policies are that are consistent with our both risk appetite, but perhaps more importantly, the broader interests of Australia.
Excellent. Thank you. Member for Reid, your 10 minutes.
Thank you very much, Chair. And perhaps I might assist Mr. Pike in following up on some more questioning around clean energy financing. Where do you see some of the opportunities and some of the trends in this space with the people that you are wanting to invest in this area?
I mean, look across the board, clearly in terms of the capacity that's required in terms of renewable. We have, I'd have to take on notice, I think maybe it was last year, somewhere in the order of 76 billion, but the way that number's sort of split between retail and non-retail, but we definitely have customers that we're, financing in terms of renewable capacity into areas like storage. I mean, our lending into renewable sectors is much larger. Over many years. There is, of course, a lot of liquidity, there's a lot of competition to be able to fund some of those assets. Obviously, I think it's it's a good thing by and large. We've been focused on trying to support our retail customers as well. We've experimented with a variety of different financing incentives. We've had support from bodies such as the CEFC to try to help customers overcome some of the capex burdens. We have an equity stake, and perhaps I'll just sort of declare that conflict in a company called Amber. I use them myself. If you can overcome the capital expenditure of solar panels and batteries, at least in my instance with my teenage daughter's power consumption, I'm getting substantial daily savings, but you need to be able to overcome the initial capex. So I think we've tried to think about it a number of different ways, and perhaps there's some other sectors as well that we're supporting directly who want to think and understand about their emissions and how to most appropriately manage them over time.
And what do you think is driving some of that interest in investing in these type of projects?
Well, clearly there's an enormous amount of investment that's going to be required to support Australia's energy needs in a significant sort of compositional and transitional basis. And it's not to say that there isn't and won't be focus, obviously, on pricing, on reliability. Of course, they loom large, but I do think that over the long term, decarbonisation and moving to renewable energy will still be extremely important. I think it will be certainly a bumpy transition, and we need to be prepared to support customers and the broader capacity and storage rollout.
And do you think the government's commitment to net zero has helped drive a lot of that investment as well?
Look, I do think over an extended period of time where there isn't, in this area and certainly in any other area I can think of, business, large and small, and capital always seeks clarity and consistency. It obviously has a big impact on their sort of return profile and expectations. So, yes, I do think a clarity around targets and policies, and not that any of those are easily set. I do think that they're important, and I'm certainly not seeking to wade into a political debate or discussion, but I think it's sort of irrefutably true that consistency and clarity are positives.
So do you think then that when there isn't consistency and clarity around the direction that the country is heading towards, that jeopardises some of those investments? It
may. I do also think that this is a very long-term transition that was always going to be uneven and challenging, particularly in the near term. I can't imagine that we won't be talking about the energy transition on a global basis, plus the consumption of energy is going to increase, I think, quite substantially. And hopefully some of the technologies that are going to be, making some productive contributions to the economy are also, we develop the capability to deliver some real breakthroughs and in some of those newer technologies. Frankly, it's going to be necessary. It's a very, very challenging task that needs to be very carefully balanced. And, I think Australia obviously has an important role to play, but also recognise that we're part of a global environment. And whilst there are some perhaps near-term shifts in sentiment, I think over the long term, I think this is still going to remain a very important and pressing issue and challenge.
Yeah. One question that I'd love to take on notice is the growth of the investments in this space and where you're seeing some of those trends in those growth. But I would like to just get some clarifying points around the 5% home deposit scheme. Is it true that those customers would, as you are assessing their applications, still be governed by the responsible lending laws?
Mm-hmm. Yes.
And I'll pick up on a point that you made, Ms McLeod, about the serviceability of these loans and the customers that you're seeing. They are, for the most part, paying off these loans?
Mm-hmm.
They are, and we're seeing In fact, the 90-day arrears as it relates to customers within these loans being slightly below the overall portfolio. So that's a very positive indication and one we keep an eye on.
So is this a fair characterisation of the cohort who are taking part in the 5% home deposit scheme, is that they are governed under quite strict lending rules, and for the most part they are meeting those loans and paying off those loans?
Yeah, I think both of those statements are true. I mean, responsible lending applies to all consumers from a residential lending perspective. Financial institutions can make a small number of serviceability exceptions. They don't have to be related to this particular cohort. I'll give you an example. We may take, as we have, a different assumption on certain sectors about what their compound income may grow at. That may allow us to slightly stretch our serviceability criteria, but these things are very carefully managed, monitored, and we report to the regulator. I say that maybe more just for clarity, but to your comments, yes, certainly at the point of origination, all of the criteria applies, and as Monique touched on, the repayment experience to date has been positive.
Yeah, great. I just want to take you, you're one of the few banking leaders who was around during the Banking Royal Commission, and you've spoken at length about the compliance that the bank has with the recommendations out of that. I think sometimes that it can become a compliance exercise, and I want to ask you what you think the spirit, the lessons, the major lessons that we ought to learn that came out of the Banking Royal Commission.
That is a good question and will require a good answer. I'll do my best. Look, I think the Royal Commission as well, it spans a number of different topics and domains. I think we've touched on some of them. The importance of clarity inside an organisation about what is your purpose, what are your goals, and I say that within what are you trying to deliver for your customers. Each of those elements needs to be carefully thought through, monitored, managed. Information needs to flow up and down within the organisation. A lot of effort goes into thinking about risks, monitoring risks, reporting on, governing them through the organisation. But also, I do think one of the most important lessons as well is the importance of ongoing and continued focus. Things tend to erode slowly and quietly versus dramatically. I think you have to always be looking for the worst examples. The averages are very sort of problematic. They can also be, things can, as I said, maybe it's related to the cultural point, sort of subtly change over time. I mean, it is dramatically different. And I can say that over a long arc of history. And that's not to say that we don't make mistakes. It's not to say that there aren't areas of I think, real frustration if we don't fulfil the commitments and the obligations that we've made. I do think it is dramatically different in terms of our ability to be able to detect those. As you would expect, there's an enormous amount of effort and enforcement from the regulator, and I say that as a positive. I think financial institutions are very complex. There are a number of sort of difficult, sort of technological, constraints at times. There's a lot of complexity in the business. One of the factors that comes from serving, every part and aspect of Australia, we need lots of different processes. And I say this not as a criticism. We're required, and we do support, customers that are incarcerated. They need different processes. You need different controls. Sometimes, again, if I was looking at a financial institution, I'd sort of think, well, how could you possibly have made that mistake? And I'm not suggesting to excuse them, but certainly my own experience, having seen them up close, is that you can never be, even in the slightest bit, complacent. Of course, at the end of the day, we're there to serve our customers. We have to deliver good and appropriate outcomes for them over the long term, and of course, as I said earlier, avoid regulatory sanctions. They're very painful and damaging.
Thanks, Mr. Common. Thanks, Ms. Situ. I'll hand over to the member for Casey, and then we'll go for a break just a shade after 11 and come back at 11:15. So over to you.
Thank you, Chair. Mr. Common, just interested, how often are you personally engaging with the Treasurer and the Treasurer's office?
I mean, whenever the need may arise, I probably...
Weekly, daily, monthly?
No, nothing like that frequency. I'm trying to think when I last spoke to him, a month or so ago. But, I mean, if there's something happening, certainly there's been times where there's been a lot of instability in markets. I may speak to him much more frequently. I certainly tend not to try to bother him with much. I think we're certainly more in regular communication with his office, but I couldn't tell you precisely how frequently.
Roughly monthly sounds like could be, depending on the situation, I understand. So I'll move on. Just want to talk about hurdles for customers to earn interest on their deposits. And just referring, the ACCC inquiry recently found that 71% of bonus interest accounts did not receive the bonus interest rate on average each month over the first 6 months of 2023. So I've got some questions. Some could be technical. If you need to take those on notice, that is fine. Does your bank offer personal savings accounts that require customers to meet hurdles to gain interest?
Yes, typically they come in the form of requiring a minimum balance growth, an increase of, in our instance, $1 on our GoalSaver product.
So just to clarify, how many hurdles do customers need to meet to gain their interest?
On that particular product, one.
And but are there others where are there other products with more hurdles that they would
not
need to
with
meet?
that sort of specific design? If your question is around where there's a minimum criteria, that is the product that we use in terms of the reward savings category, which I suspect is exactly what the ACCC is referring to.
Yep. And can you provide, for each of your bonus savings accounts, the percentage of customers who did not get the advertised bonus rate in each month over the last 6 months?
I can. We reported as well in an aggregate in our full year results in August. I think the number was 87 or 88% that did get it, so that will leave you with 12%. It's up substantially from the time period that you're referring to, and precisely for the reasons that you touched on. And we've put a lot of effort into alerting customers such that we can maximise the proportion of customers who are getting that bonus interest, which is obviously what's driven the increase.
And can you provide us the average interest customers actually earned on each of your bonus savings accounts and how this compares to the advertised rates?
Sure, happy to take that on notice.
Perfect. And how many of your customers do not earn interest on their deposits?
Well, I'd have to take that precise away, but maybe it would just help if I ask a clarifying question. Are you referring to customers in savings accounts? Or
yes, so non-interest bearing retail deposits.
Non-interest bearing, okay, in transactional deposits.
Yep.
I'd have to take the specific numbers away on notice.
Yeah, and you've alluded to this in the numbers, but has your bank, and could you give a little bit of detail on what you've implemented in terms of transparency measures in response to the 2023 ACCC retail deposits inquiry?
Yes, well, specifically, which is where I'm perhaps more familiar, is in the product like GoalSaver, which my understanding is a lot of alerting, both in email and I think potentially in-app, but I'd need to be able to check that. But I'm sort of much more familiar in terms of what the quantum that's shifted, which I think is I certainly know it's either 86 or 87%. That are qualifying as at August, and I think from memory that's up from something like 71%. 3 years in that time frame that you're referring to in the ACCC, but I'd very happily double check those numbers.
Thank you. And do you think it should be easier for Australians to earn interest on their deposits?
Well, I think I guess I would submit that based on those numbers, it is easy.
And do you think hurdles to earn an interest floor, perhaps pegged to the RBA cash rate, should be banned?
Sorry again?
So do you think hurdles to earn an interest floor perhaps should be banned? So do you think it's appropriate that you charge hurdles, put requirements on your customers to earn interest on their own money?
And I do, because I guess by definition we offer those accounts.
No problem. Thank you. I just want to move on to illicit tobacco. As a Victorian, it's a big issue in my community and many communities across the country, and we're seeing not just the illicit tobacco, but also the crime, fire bombings, etc., that are impacting innocent people in the community. So interested in what steps your bank is taking to ensure that it is not providing merchant services to retailers of illegal goods.
A number of steps, and this was reported recently, which you may or may not have seen just in the last couple of days. I mean, like you, this area is a real cause of concern. Maybe I'll speak specifically to illicit tobacco and clearly the growth of illicit tobacco, which, amongst other things, has been linked to crime, facilitating money laundering, and also denying the Commonwealth of billions of dollars in excise duty. So, I mean, look, we've made a decision that we're substantially going to reduce or restrict the services that we'll provide, both at a banking and a payments perspective. In the article, which is true at a substantive point, we've made the decision that strategically we're not comfortable with the risk profile. It is possible that as part of that engagement with customers and maybe some of the restrictions that we put in place, we may inadvertently identify customers that perhaps aren't engaged in that. But we obviously are creating a process where customers are able to engage with us. And I mean, if we make any decisions individually, then that would be a source of regret, and we'd be happy to apologise. But to your broader point, we've made a decision that we want to substantially reduce the banking and payment services to this sector for the reasons that you touched on.
And obviously AUSTRAC had their recent statement on illicit tobacco and cash-based laundering risks. Has AUSTRAC contacted your bank in relation to this issue since releasing its statement or prior to it?
I believe they did. I haven't personally. I think it was perhaps earlier this month, but I could double check the exact area. But I mean, similar to one of my answers, where we have regular engagement with our regulators, including AUSTRAC at all levels of the organisation. So I've no doubt that there's a good and effective working relationship and understanding on this particular topic. There's no question that this would be a cause of concern for them, as it would be, I assume, for law enforcement.
And I think last one, Chair. Has your bank identified any operational concerns arising from AUSTRAC's warning about illicit tobacco cash flows? And if they have, what are those concerns?
Well, I mean, it goes to the broader point of sort of our strategic policy in terms of reducing the services that we'll provide to that sector, given the risks associated with that. I mean, for all customers, we have very clear obligations as well that we need to understand, the type of business, the purpose, where funds are coming from. There's a whole range of different sort of obligations. So, I mean, I certainly wouldn't link it to this. Sometimes we have to do that on an individual basis. Individual customers understand their source of wealth, turnover, identify any suspicious matters, and we have to promptly report those to AUSTRAC. And occasionally we look at whole sectors, and we think that the risk profile associated with that makes it very difficult, if not impossible, for us to provide banking services to them, and so we seek to cease doing so.
Perfect. Thank you, Mr. Conlon. All good.
Okay, so we'll adjourn for a quick break until 11:15, and we'll see you back at that point in time. Thank you. Now hand over to the member for Moreton.
Thank you very much, Chair. Good. Thank you, Chair, and thank you very much for coming to give evidence today. I was going to focus on home loan offset accounts and was going to ask in the first instance, are you aware of ASIC's concerns surrounding potential issues with the operation of offset accounts not functioning as intended, as referenced in their strategic plan?
Yes, broadly, I think so.
Yes. And when you became aware of that issue, did the Commonwealth Bank take any steps to investigate whether indeed your own offset accounts had been functioning properly?
Look, I'd need to double check, but it's an area that we have reviewed in the past. I'd have to check the periodic or the frequency of those reviews. And look, I think it's reasonable for ASIC to be focused on, and there can sometimes be some complexity with the establishment of that. So perhaps I could take that on notice.
No, happy for you to take that on notice. And I was going to ask, in those previous periodic reviews, were any other issues uncovered with respect to those offset accounts in the past?
I mean, I'd have to double check some of the specifics. I mean, the offset account is generally making sure that the account is set up as instructed by the customer. Sometimes there can be multiple accounts, multiple offsets, some of the linking between those accounts. It would be issues of that nature. But I'd have to double check to be more specific.
No, I understand. I was going to ask, who do you think the onus should be on in terms of detecting any errors of that nature?
I think it's incumbent on financial institutions to review that and where mistakes are made to remediate them. I wouldn't necessarily want to imply that would be in a real-time basis, but I mean these are reasons why we have control tests and reviews and sometimes audits of different areas, and unfortunately from time to time they do identify that there have been some operational errors. Sometimes they're very easily picked up. Obviously we invest in what are known as preventative controls, basically ways of preventing mistakes from being made, but it's also important for financial institutions to have means to be able to detect those variations, and if there's some benefit hasn't been provided to the customer that they're contractually entitled to, then it should be promptly, and to the extent that there's been any period of time where that benefit hasn't been applied, then it would be applied, and we have a formula to calculate the interest payment over and above the dollars that are outstanding, which is I think it's a referable rate to the cash rate plus some form of penalty interest.
Thank you. I might just move on to AI. Can you take the committee through where you've deployed AI across your bank and what functions?
Yes. Perhaps AI in the context of perhaps more traditional techniques, including machine learning for more than a decade. Machine learning being more advanced analytical techniques that effectively make predictions. We use that in, probably the most well-known would be in the mobile banking app. We provide personalisation and experiences within the app. We would be making certainly tens of millions of decisions every day based on billions of data points. We use at least some of those techniques, which would be known as AI or under a family of AI and machine learning, in areas like credit decisioning. More specifically, I think obviously there's a lot of interest in generative AI, based on large language models that use a particular technique around neural networks. We are using that in the digital experience. We're trying to build out the ability for customers to be able to ask broader questions, to be able to interact. We would like to be able to, more specifically in areas like fraud and scams. We are working on a variety of different both internal use cases, so helping staff members in terms of what's known normally as like some form of knowledge or retrieval, or RAG technology, which basically retrieving policies, procedures, helping our people get answers. We've rolled out capability and tools to just about all of our employees. There's some restrictions. There's a number of other use cases that we are working on as well, and a number of use cases which are going to be really important to be able to protect our customers from what we see as increasing sophistication, which I'm happy to talk to in some detail, and sort of areas around scams and fraud and cyber in particular.
And understanding that you've been working to use AI to increase or improve scam fraud detection, but also to change the customer experience. Have you implemented the use of AI to reduce costs for customers?
We've implemented AI across a range of use cases. Some of the benefits of that, I think it's really important that the benefits that we're seeking to deliver are not certainly solely weighted towards costs. I mean, our primary benefit that we're seeking is improving customer experience, but there will be some instances, and there have been to date, where there is some cost savings that are available to us. I'd say overall they're relatively modest at this point, and this is an area that we're giving a lot of thought to in terms of the appropriate deployment and how to manage, as I said, the benefits that we deliver to customers, not just related to cost reduction.
And where is consumer data processed or stored for those AI systems?
Well, there's obviously a lot of data that we hold in a lot of systems, but if I simplify it down to, we have what we call a relationship. We have a single system that manages a customer view and most of the interactions that our team have with our customers. That's known as ComSI. We have a core banking system that obviously has its own database. There are a number of different sort of data stores that hold different parts of information about different customers. We obviously have to do a lot to keep that data both protected and to a high quality.
And are there any specific safeguards for data that is used in AI specifically that have been developed for obviously the increased use of AI?
Many. Yeah. I mean, if I to the extent that it's helpful, we have a lot of processes, frameworks, policies around governing the use of AI, as we would for any model. It doesn't need to be an AI model. It can be a more sort of statistical or regression-based model. There are verification, validation. There are particularly things such as guardrails which protect against use and misuse. There are very clear responsible guidelines which we've published. We seek to monitor the performance of those models. Of course, we're very conscious about the information that we're using, whether customers are given their appropriate consent, how that information is used, how that may result in inappropriate outcomes. All of those areas are modelled and understood and monitored closely.
I'm interested in the impacts on workforce in this space. We've seen some reports about people's jobs being impacted by the presence of AI chatbots. So can you please take us through what tasks are being automated and how you're managing those workforce impacts?
That's the last question.
Yeah, I mean, look, there'd be categories of tasks. I do think maybe a couple of things. One, I think the impact on individual, the totality of employees at this stage is small. I do think it's perfectly understandable that there is, some degree of trepidation and concern about how AI may influence and impact tasks, skills, what new skills will be required. This is a very important area of focus and something we've been communicating a lot with internally. It's hard for me to give you a generic answer because, my general expectation is that at least a subset of tasks that just about all of us do over time should be at least augmented by AI. I think actually the commercial pressures that I touched on earlier, I think they'll be felt more acutely, not through an AI lens per se in the near term. I think, over time, though, there certainly is the possibility that that's going to, the probability that that's going to have direct workforce impacts. We're spending a lot of time trying to think through how the workforce may change over time, acknowledging we certainly don't have all of the answers, and there's also tremendous uncertainty. But this is an area that, we've certainly given quite a bit of thought to, and want to make sure that we're engaging appropriately, not just inside the organisation but also externally. It's clearly an area that there is enormous public interest.
Thank you. I'll hand over now to the member for Deakin.
Thank you very much, Chair. I was wondering if I could revisit that $270 million or $280 million figure raised before. As I understand it, these were fees paid by a low-income cohort in connection with high-fee accounts, which they didn't need to be on because they were eligible for low-fee accounts as well. Your earlier answer referred to goodwill payments rather than remediation. Is the bank's position that it complied with its obligations under the banking code to those low-income customers?
Yes, it is. And I guess, I'd make the distinction that I think it's perhaps more of a generalisation to say all of those customers are by definition low income. I don't think there certainly are low income customers that are concession customers, but definitively not all of them. Those fees were charged, as I said, in accordance with the terms and conditions. It's not to say because
if I could interrupt, that these are the terms and conditions of the high fee account that they're placed on. The question really goes to, were they informed of their right to go onto a low fee account? Well,
as your question touches on, there are a variety of different accounts. The more basic low fee or zero fee account is available to customers. Obviously, it has perhaps more restrictions or certainly less features.
Was the availability duly disclosed to those cohorts that you were required to disclose it to under the code?
Well, I believe it was disclosed. We may have differing views about the adequacy of that disclosure, and to be candid, I'd have to take on notice exactly what steps were taken beyond sort of broad generalities.
So would it be fair to suggest that in cases where it was found that the bank had not fully disclosed as required by the banking code, and that a person found themselves in a higher fee account and therefore incurred higher fees, that they would be entitled to remission?
I think there's a number of sort of leaps in the premise of that question, which
feel free to fill them.
I wouldn't be prepared to accept. I mean, I do think it's reasonable, and this is also a topic that I know is in for consultation with the ACCC about whether the specificity and the level of efforts that are taken to migrate customers, and there's certainly a preference from some stakeholders to automatically move customers from one account to another. There's a spectrum here of perhaps, and I think individual preferences would differ. Some people would find it, they certainly wouldn't appreciate being moved from one account to the other, even I think in circumstances where perhaps there may be lower fees. I don't doubt that there may be improvements that we could make to the information, the way we engage with customers. As I touched on earlier in answers around the reward saver, I think there's good examples where we've done that. So I'd acknowledge that there may be areas for improvement, but I wouldn't accept some stepping stone liability equation.
So the premise that that losses incurred as a result of the bank not complying fully with its obligations under the banking code, if such a loss were to have incurred, would that...
I'm not sure. I wouldn't agree with the characterisation of it as a loss, nor would I agree with it as excessive.
So paying fees that they would not have been required to pay had they been fully informed is not a loss?
There's a lot of ifs in that statement.
Well, let's say hypothetically they were incurred and would not have been incurred had they been placed on a low fee account. That's not that much of a leap, is it?
No,
there would be some in that cohort, even if you don't accept that everyone's a low income earner, and that some wouldn't have chosen to be on a high fee account, that there would be some, at least in that cohort, who were placed in an inappropriate account and incurred avoidable fees as a result of a lack of disclosure of their options.
But I think you will find, at least my view would be, that will hinge on what steps were taken, whether they were appropriate. I don't think the obligation is going to be to ensure that we forcefully migrate every customer into that, and therefore there's a consequential loss from that. I mean, imagine the implications of that across all parts of the economy.
So my question
you're assuming no agency or involvement in that decision making.
I think this is about agency and being fully informed at that initial instance, that these are your account options. As a low income person, you're eligible to be on this low fee account, and that will mean you incur lower fees.
Sure.
The migration's a kind of separate question.
Well, but I believe that steps were taken to make those options available to customers. As I said, we may agree or disagree whether those steps were appropriate or not. I think then the leap to imply that somehow those fees were either unlawful and deserve remediation. I just don't think is correct. But as I said earlier, it's not that we are not contemplating because we are. What do we think the appropriate rectification is? But I do think it's a very, putting on the side the specifics, a very challenging precedent to then say if something was actually operated the way it was designed, but now you want to go back and retroactively change things. I don't know that that's a particularly strong foundation.
So would there be a process, and I don't know if it's been developed yet, for the bank to review whether someone has, whether the bank was, discharging its obligations in full on a case-by-case basis, understanding that, every interaction is its own, for that to be revisited in a simple enough process for people to have their case looked at?
Yeah, look, there's certainly a lot of steps taken and changes that we've made on a go-forward basis, and I think that's a much easier, equation to both comprehend and contemplate. I think, as you would appreciate, with millions of customers over, I think the time period was 2019, it would be very difficult to determine exactly, of course, what offers or where the information was made available, but how people engage in that information would be challenging, I think, to establish.
So you were saying going forward, so you haven't got a program for revisiting that kind of cohort of customers?
Well, I do, insofar as the customer cohort that we're talking to, that you're referring to try to find an appropriate, as I said, goodwill payment, which I think strikes the right and appropriate balance. But I also accept that reasonable minds may differ about whether the judgment that we form there is something that is entirely consistent in this instance with how you may view it.
So when will we know the kind of full scope of that program?
Well, I certainly would think that will be in the coming months, and I'm confident by the time our next appearance, I'm certainly happy to provide some update if that would be helpful to either the chair or yourself.
And it certainly would be, thank you. I'm just going to switch topics around because I realise we have limited time.
I don't mean to interrupt. Just very quickly, and I'll make allocation time. Mr. Common, with the greatest regard, I think this is a sticking point. I think that there are going to be differences of opinion about how CBA is managing this. This is a low-income cohort. You can take on notice and let us know the percentage, but I just think if there's the question about agency that's been raised in the back and forth here that I think is worth following up. I take on board your point about forcible movement of people, but giving them the option to go for a lower fee account and for them to save money. And if they've been on a higher account, ASIC has taken a different view to your organisation about how to manage it. I'm just saying, I think I'll take on board your point about reasonable people. I think reasonable people would see that that this is a sticking point that I think would be good for revisiting, and we'll be very keen to hear how CBA is managing it, if I can put it.
Yeah, no, I'm entirely comfortable with that and happy to do so. I guess, I make a number of sort of comparisons. Would you make the same comment if someone was, paying a higher interest rate on their loan or their deposit than someone else, if there was a better offer that was alternative to them? I think the distinction that I'm seeking to make is that there's a difference between conduct that's in accordance with the terms and conditions versus conduct that is not, where there are clear obligations and breaches, and we're moving from sort of contractual obligations into well and above and beyond that, which I do say is appropriate in some circumstances. I don't think by definition it's therefore appropriate in all circumstances, but I'm happy to provide an update and accept that there.
And when you say terms and conditions, do you include the bank's obligations under the Banking Code post-2019?
Yes, I do.
Cool. Could you give the committee an update on how what your bank is doing to support banking in regional communities at this point?
In what regard specifically?
So I know there's discussions between banks as to how we can ensure the longevity of access to regional branches. So an update on the work being done in that space.
Yes, well, we announced, I'm trying to remember when, but some time ago that our branch moratorium would extend. It was initially until the end of 2026, and then we extended it to 2027. So I think sort of clarity and consistency in terms of regional footprint. We also offer access access through Australia Post or Bank at Post. We've recently, I think it's a matter of public record, perhaps not the specifics, but renegotiated and offered to provide additional payments to them. We, amongst a consortium, have voluntarily increased the payments that we were making to the cash utility that, the cash services provider. And so I think there's certainly clarity and consistency over those services. Regional Australia, of course, is very important to us. We have by far the largest physical footprint in terms of branches in regional Australia.
And in addition to that, we've obviously looked to extend services where we can by using multi-channel branch time in regional areas to actually utilise that half the day through branches, half the day through call centre. We also look to roll out programs such as the First Nations Reach program, whereby we go to remote communities. So we've actually built that program, and we visit 33 remote communities, go in for 2.5 days, really try and help with banking and education as well. So there's a number of other things we have in train beyond just the network itself.
So, I mean, the moratorium is presumably a stopgap option. Have we looked at kind of business delivery models post-moratorium, whenever that might end? What is the future? Is it, a bank branch acting as an agency? Is it an industry levy that incentivises any bank having regional bank, branches? Are there kind of longer-term models that are being explored among the industry?
Yeah, I think they're important questions. I perhaps need to be somewhat mindful that despite media reporting, and others are under sort of NDA as it relates to some aspects of that, but perhaps we'll sort of make a broad generalisation. I think you could even conclude from those that I'm sort of broadly supportive of something that would require financial institutions, large and small, to at least make a modest contribution, and any reasonable expectation we would have that we would be making the most significant. But this goes back to this point around the way the market is reshaping, and we may have differing views about. There's a lot of focus and intensity on competition in and around wealthy urban customers. It is expensive and hard to service regional Australia. It is also critical, and so getting some appropriate commercial balance we think is important. There's a number of different ways that could be done. Certainly, we have the intention and wish to provide those services well into the future.
Okay, one quick question from Mr. Violi and then over to Ms. Jarrett.
I thank Ms. Jarrett for indulgence. Just on that regional banks questions from the member for Deakin, following up, I know Westpac announced that they were going to extend their moratorium from 2027 to 2030. They announced that this week. Is that something Commonwealth Bank is now actively considering as well?
It's something that we're regularly thinking about. It's not something I'm going to give any, specific conclusion to at this point in time. As I said, the moratorium already extends into 2027. I think we've got 281 regional branches. I think that's approximately 54% more than Westpac does. I mean, obviously, any institution's free to make whatever decisions they would seek to. We certainly intend to have, a significant presence in regional Australia and support all parts of the country, and that's will continue to be our focus.
Thank you. The award for greatest indulgence goes to the member for Brisbane for indulging the extra time. You've got 10 minutes. Starts now. Over to you, my friend.
Thank you, and thanks for your evidence today. I'm going to cover off on scams and a couple of other things, but let's start with scams. We've got the National Anti-Scam Centre saying there's approximately $2 billion in losses affecting almost 500,000 people. The government's spending hundreds of millions of dollars to fight scams. You've said that you are spending yourselves $1 billion on financial security. I'm interested to know how much of that is going into anti-scam prevention, but also are you seeing any trends that we should be aware of in terms of how this challenge is progressing?
Yeah, thank you. I mean, the number that's reported is, of course, difficult to estimate. It's, substantially larger than the number that we would see, but there's questions of underreporting. I do think, and this has been covered, there has been a lot of progress made across the industry, at least as I said, from what we saw at the peak, I think, which was 2022, where it's down something like 76%. The $1 billion that I mentioned a few times, that's across what we would categorise as economic crime, which is financial crime, scams, fraud, cyber. The reason as well is there's a number of protections that we're working on at any point in time that serve multiple purposes. So, I mean, I'd be happy to detail all of the things that we've done to reduce scams by that point. We're very supportive of the scams protection framework. We're supportive of the higher obligations on the banking industry. Of course, we'd like to see those applied equally across other industries. They will come with, I think, protections as well as obligations that will enable greater information sharing to be provided across the ecosystem that I think will continue to reduce. Specifically to your question, maybe a couple of particular, so that scams obviously broad range of different categories or subcategories. Happy to talk to as many of those as would be helpful. Two that we're perhaps focused on where we've seen pressure is in what's known as a business email compromise, whereas maybe the business is sort of via a cyber attack gets access to their information infrastructure, may seek to, amongst other things, modify their bank details that they're putting on their invoices, and so a business customer may unwittingly send that to one of their customers. The customer makes that payment. Of course, we're obliged to make that payment on behalf of the customer. That's where things like confirmation of payee are so important. And then the second area where there's real growth, which perhaps supports my earlier point around ecosystems, is an increase in buying and selling scams on marketplaces in particular. That's often where someone's purchasing, or they think they're purchasing something, but they're in effect purchasing nothing, or via a scam. And so these are very difficult for us to predict in ahead of time, but as an example, that's an area that post the implementation, and there's a lot of work that needs to be done between these codes, information that would show that, let's say, Monique was subject to one of those scams, which I'm not suggesting you were, and then we'd have obligations to respond to that. So if there were particular bank details, we'd have to be able to prevent payments. There has to be a way that we're able to work collectively across the seams of the economy to continue to reduce scam losses. It's a very high priority for us. To your question about how much specifically in scams, I'll probably get into difficulties around splitting which is which, but I'm confident it's above $100 million.
And it's good to hear that the scam prevention framework is being perceived, I guess, positively. How are you going in terms of implementing it, or getting ready to implement is probably a better way to say it? I think
it certainly needs a lot of focus. I think the former member, Stephen Jones, who took that through, I think it is genuinely a leading piece of global legislation. The understanding, or certainly the expectation, was that we would do everything we can to support that. The overarching legislation is created. What needs to happen and is underway, and obviously Treasury are drafting, is these industry codes need to intersect. There'll be some other elements that will need to be updated, things like the e-payments code, which didn't specifically contemplate some of the details within scams. ASIC's got some work to do there, and I'm sure they're well across. Obviously, the ACCC plays a role in that. Then we've got to get clear on liability. How's that going to work? We've got to make it simple enough for customers to be able to navigate, because consumer groups quite rightly would have an expectation that I've got a front door or as few doors as I need to engage with. Imagine the tedious nature of trying to work out whether it was where you'd go within Meta. There might be multiple financial institutions. Yeah. So there's a lot of really important detail. I think, speaking to a member of my team that's leading all of this work, I think and hope we're getting close from a bank perspective. This is a key topic at the next ABA meeting in a couple of weeks, hopefully, to get as much alignment as we possibly can. And then, of course, we need the support and encouragement. I think it's fair to say that the tech sector will be reluctant participants. I don't think that's too much of a stretch, perhaps not all equally. So they may need more than encouragement. But I do think if implemented, notwithstanding, there will come costs to us. This is a much better system. This is going to deliver real benefits to Australians. And one thing is evidently clear over the last few years. Organised crime do not have a productivity or an innovation problem.
Yeah. And I would just add the one other piece is the actionable scams intelligence sharing and real SLAs around that, because what we can see through lots of different examples or case studies is where we have been able to share that when we can act really swiftly is when that's two ways. We need everybody at the table at the start, because that's the way that will make a real difference.
That ecosystem approach is very important,
Absolutely.
I think. Yeah. If I could just switch gears, Chair, I just want to go back to the fees and charges on low-income customers, and noting also that the CBA really has a real focus on customer service and looking after its customers. And I appreciate that you're challenging the 270 or 285, and to the extent that some of that is overcharging, some of it may not be. But I think you also sort of said some of that has obviously been done within the terms and conditions at the time. But given CBA has a licence, social licence to operate, and you mentioned that yourself, Mr. Comyn, at the start. How do you reconcile that, right? How do you reconcile charging, knowing that you're overcharging customers or have? You're prepared to do some goodwill payments at this point, but I can tell you there's a lot of people in my electorate on JobSeeker and other allowances that would have been hit by this.
Yeah, look, thank you. Perhaps maybe what I'd say, without going back down, because I'm not sure I have a lot more to add on the specifics, but maybe let me go up more broadly. We are acutely aware and focused on our social licence. We, as I said, have a breadth and depth of services that we provide to customers. One aspect of this as well is we have to both, contemplate, and we already do, not only our obligations, but also like generalised expectations over and above those. I would at least categorise this as a level above that. Then I would sort of look to, there needs to be sort of the sustainability of being able to provide those services, and perhaps I'll sort of return to that. And this is an overarching element, and I know this can easily be misinterpreted as the banker sitting here. We don't seek to maximise returns. We seek to earn a reasonable and sustainable rate of return. What worries me is in a market structure, and look, I'm linking a few topics and I could deal with them in isolation, but this is still equally valid and I think important strategically for the committee to understand, where the commercial pressures are great around heavy competition for affluent customers, a whole range of institutions that seek to not only provide no service to any of these customers, make no contribution, that's fine, that is our issue that we need to be able to deal with. We need to have some sustainability of services, because in an industry where an ever-increasing proportion of customers to serve those customers, the costs cannot be recovered. I've not seen an industry anywhere in the world where on an ongoing basis that doesn't lead to a loss of accessibility or a degradation of service. And this is, is quite interesting, and perhaps I'll use one sort of example, which I think's hopefully relevant. It's also substantially my fault, so I think it's a reasonably valid case study. In 2017, we removed ATM fees that you pay on other financial institutions. I thought that was a good idea. I don't think it was such a good idea now looking back. Why? Well, mortgage profitability was more than 2x what it is today. There are a whole range of other fees that we've eventually been pressured into, which is fine, reducing. Now, ultimately, what's happened, which we didn't contemplate at the time, financial institutions have sought to, at scale, offload their ATM networks. Why? Because there's no commercial model around that. Who charges the fees? Third-party fees, third-party companies that are not subjected to the same social licence obligations. I'm not even suggesting they should be. So I've sort of defrayed and moved one cost to another. It's just an example of this sort of like pernicious slope. And it's the slippery slope that we're seeking to avoid. We're trying to come at this issue with a set of principles. I think we probably broadly align with those set of principles, but we may, I suspect, not entirely align with the application of those principles. And I'm simply seeking to underscore we're trying to strike the right balance between what we think is appropriate, fair, consistent with all of those, and consistent with our broader obligations, or certainly my obligations to the owners.
I understand what you're saying. I understand.
Yeah, I'm using shareholders and owners interchangeably in that context, but yes.
Yeah, I understand that you're a business, but what we're really talking about here at basic tin tax is overcharging and compensating low-income earners who are overcharged, and noting that CBA is taking a different approach than than your competitors.
Yeah, I won't waste the time by sort of refuting a number of the descriptors there, because I don't think that's the case. And yes, we are taking a different approach, as I think we took a different and more generous approach to the Indigenous customer cohort. Yes, we've at this stage taken a different approach to the other institutions that are in there. The scale, breadth and reach of the services that we provide is unmatched. But again, obviously institutions can make their own decisions. We're attempting to strike the right balance. I certainly register and acknowledge the questions that I've received on this topic, and I'll be happy to provide an update.
Thank you. Thanks for that. Going back to AI, I've got 5 minutes of questions, and then the Deputy Chair I'll hand over. Some I'll take on notice in terms of how much you're investing AI, I'd like you to take on notice, I should say, how much you're investing in AI and growth-focused tech and in what areas. But I would like to ask quickly 3 questions in a general term. How you disclose AI use to your customers, including when they're interacting with AI agents or when AI influences decisions. As the MD, you've said, and I do respect the fact that you've really lent in terms of the application of tech in your institution, but you've said CBA will continue to keep humans in the loop as you deploy AI, so I'd be keen to know what that looks like in practice. And finally, you referenced today credit decisioning as an area where you use AI. So how do you test for discrimination bias in automated decision making, especially for low income or vulnerable customers? So those 3 questions about disclosure, humans in the loop and discrimination bias.
Certainly, let's start with the last one. How we manage around a whole range of different sort of biases, or we'd say unintended negative effects, happy to provide detail on that. There's some comprehensive processes around that. Yes, broadly to humans in the loop. I mean, we've also had some observations about that as well, insofar as depending on the quality of the model, even having the human in the loop, people over time perhaps don't have the same sort of rigour. It's different, but analogous. That, if I was self-driving for 10 years, my car required me to take over in an emergency, I dare say my skills may have eroded. So we've got to try and strike the right balance. There's a lot of interesting learning for us. Broadly, what I would say to influencing, where we use statistic, and this is a spectrum of where what could be known as AI, but I've sort of certainly put machine learning underneath that. We basically cover that in the context of our terms and conditions on individual products. Obviously, there are restrictions to how we could use that data. I can't recall specifically what the terms, but there are tests against the privacy obligations, but I'm sure there's a reasonableness test. At least where a customer is interacting with AI, we have all sorts of different, and this is a very small aspect of what we're doing today, but I think an important one going forward. We tell the customer, we give them the option to opt into that process. I think more than 2/3 of customers are now sort of opting into that process. This is really an important area, which I'm sure is behind your question, Chair. There is enormous capability with these models. The ability to perhaps what is known as hallucinate is sometimes misunderstood. It's more of a feature, not a bug. It's very hard to entirely control for that, but it's also extremely capable of providing high quality information. We're trying to work out how to intersect between the expectations we would have in ourselves, how I think the law will apply, how those obligations will be perhaps enforced on others that would currently be sort of outside of the regulatory net. I think these are going to be important things to be tested in the coming years. But I mean, there's certainly parts of our service model that we can identify that would augment and improve the customer experience, and if we can do that safely and reliably, then we'd seek to do so, and we expect and anticipate, as we should, to be subjected to a great deal of scrutiny and we'd be happy to respond to any questions in that area.
Thank you. Thinking about the fact that you've moved your core banking system into data centres managed by AWS, I was contemplating that as you were answering the questions to the member for Moreton around onshoring and offshoring of data. The other way to rephrase that question is, what are the expectations that CBA places on, say, AWS about where the data is stored?
I mean, a range of obligations specifically in that area. Onshore, they have multiple domestic data centres, which are effectively part of a cloud-based operation. Most of I think all of the significant players in Australia have data centres that are effectively all onshore.
Right.
We have very strict restrictions about what sort of data would be permissible at all on an offshore basis.
And I notice people are keeping tabs on how rising technology and cloud service costs are feeding into your cost base. How are you tracking that risk?
Mm-hmm. Yes.
How are you tracking
it? By seeing it in the P&L every month. It's up substantially. There's clearly a trade-off. Often your costs actually of compute and storage go up. And so it's sometimes misunderstood. You're generally paying more money to be in a cloud environment. Maybe it's going to depend on your workloads, but what you're getting is a greater sort of resilience and capability and security and monitoring that's very difficult to replicate. I mean, we still have some what's known as on-premise applications that run in our own data centres, but they are running over AWS or, frankly, some of the other cloud providers. I mean, 6, 8 sometimes data centres. They're just at a level of sort of scale and capability, but it's not to say that they can't, as recent events have demonstrated, ever have any instances. So, look, we expect to provide still some on-premise data workloads. There are advantages, at least in the near term. They're not necessarily financially driven to move into the cloud, but there's a number of other technical capabilities that you can take advantage of when you're in that environment.
Yeah. I've got some questions on the strategic partnership with OpenAI, but I'm going to put those on notice if I may.
Sure.
The last one I did want to ask, look, just within this room, I have a complicated relationship with chatbots. I'm not a fan, so I'm just confessing that to you, if you don't mind. But I think agentic AI offers something... What's that, sorry?
They don't like you either.
I can tell by the way they deal with me. Agentic AI, though, there's a lot of focus on how that'll help guide customer experiences and customer applications. How do you see that? Is the Commonwealth Bank contemplating the role of agentic AI in its customer offering?
Yes, we are.
How are you? Is there anything that you see where this will play a particular benefit for customers? And that's my last question.
Well, I mean, I think effectively, what does agentic AI provide? Well, I mean, the models provide intelligence. What agentic, or what's broadly referred to as agentic, enables you for those individual agents to have access to that intelligence, to have access to tools that can come in lots of different, and it enables you to sequence or manage or orchestrate work. It's very early days, but are we experimenting with those technologies? Do we see? And you can go from a very simple agentic use case, you can go to a more complex, anything that's longer running, anything that requires more comprehensive orchestration is by definition going to be more challenging. The technology is still nascent. I mean, I think this will be clearly an area of focus over the next couple of years, and it would rely on the trajectory of model improvements continuing at a very rapid rate before you could, I think, undertake very, very high sort of accuracy workloads. But we're definitely experimenting with these technologies in a number of different ways, including some of the really challenging areas, including economic crime that I touched on.
Okay. And I've also got some questions on notice the Scam Victims Alliance has raised with me, so I'll put those on notice if I may. Over to the Deputy Chair.
Just to touch on energy again, I think one of the previous members talked about whether it's a structural driver of inflation. Does your research team look at energy forecasts as part of their inflation forecasting work or economic?
We certainly have